last week of the month. So that's that'll keep that moving. So first of all, what I'd like to do now is we're going to take a look at the slides, and then we're going to have our Q&A. So here's what we're going to do today. We're going to talk about the key economic indicators, the global economy, the domestic economy, mergers and acquisitions, other significant economic news, and the real key today is going to be on employment trends in a challenging economy. So the first thing I'd like to talk about today is the following. So, you know, the employment trends are changing rapidly on a daily basis. So in a challenging economy, employment trends are really influenced by various factors such as technological advancements, global economic conditions, political policies, and social changes that are taking place. Overall, changes in the United States economy will significantly affect the U.S. workforce and will reshape most traditional elements going forward. Advancements in artificial intelligence, robotics, and other new technologies and platforms will change work tasks and the need for labor content. Employers are increasingly using subcontractors and lower paying alternatives to many traditional arrangements. We're seeing technology continue to disrupt traditional industries while new roles keep emerging in response to the needs of the 21st century economy. So with the advent of technology, we're looking at process improvements, new policies, new industries as well, and employees will be faced with the challenge of disruptions going forward in the future. We'll see more of that in a more timely basis. So in today's changing environment in the marketplace, those who keep up with the latest trends will be positioned for success. So those on the call today that are in the process of making transitions are well aware of what we're talking about. As you can see now, since the pandemic, more so now than before, a lot of people are now beginning to work remotely. They may be in the office one day a week. Sometimes they won't be in the office at all. Now, since COVID, as I said earlier, so many jobs, for example, the technology jobs, jobs in marketing, customer service, most of those can be done remotely. And then periodically we'll have to go to a market or to an office to go forward. Now, the gig economy, the term has been around for a while. But what is the gig economy? Well, it's defined as a labor market characterized by flexible, temporary, or freelance jobs, as opposed to permanent full-time work with this model, where a substantial number of individuals work part-time in a temporary position or as independent contractors. For those in finance, and I hate the term, they use it, it's called fractional CFOs. That's where one person may have one or two clients or more that they visit on a weekly basis. So therefore, that's how they spend their time. They're full-time focusing on those types of entities as opposed to working for a company or an organization full-time. Artificial intelligence, you're all aware of it, and artificial intelligence is the cause of unemployment. The main corner of artificial intelligence is really related to job losses. Replacement of humans with AI machines can lead to large-scale unemployment. Now, robots have eliminated numerous employment opportunities and positions throughout the manufacturing and the mechanical production system. And in automation age, tasks are being finished by robots. So unemployment is socially unwanted as we move into the future. Now we have something called prompt engineering. This is a new job profile. And Gene, this is something you may be familiar with. So AI basically continues to influence the employment landscape. And a new category, as I said, is called prompt engineering. And that's a new breed where you specialize in crafting specific instructions and also prompts for chatbots. And what happens, the work with these variety of tools and techniques creates prompts that clear and concise informative information to get the produced and get the desired result. Social media is another significant area. We're looking at social media recruiting has emerged as an increasingly popular employment trend among hiring professionals and recruiters. And a recent report indicated that a significant portion of job seekers use social media to obtain employment. And of course, LinkedIn is the networking platform that underscores this particular area. Now, when I worked in the Bay Area almost 11 years ago, companies began to hire people in the HR department. And those people were assigned to follow their applicants thoroughly to see what they were doing from a social perspective, to determine whether this person was somebody that they wanted to hire or there was a reason for them to decide not to hire that individual. So social media plays a huge area, as well as the job seeker. It also is on the people looking to hire the people as well. In the area of digital skills, as work increasingly becomes more digital, the new technologies will be introduced from left to right. Developing digital skills is becoming extremely paramount. Technology such as machine learning, robotics, augmented reality, artificial intelligence, and the cloud are making inroads in just about every single industry and job description that you can imagine. In real estate and coaching, I mean, this is just all over the place. If you look at a football game, you'll see guys on the sidelines with all their tools, looking at plays, looking what transpired. So it's really automating everything that we see taking place today. The area of green jobs, is a major element within the U.S. economy. And with aggressive trends in environmental markets, green jobs and occupations of employment are growing on a continual basis. And again, to preserve the environment. These jobs play a critical role in mitigating climate change. If you look at the skills over jobs, this is another key area. In 2023, more companies are considering alternative credential programs like courses or certificates during the hiring process and to increase their spending on in-house upskilling of efforts. So leaders are realizing that upskilling employees and creating career paths can help their organizations close skill gaps and perhaps even help in retaining employees. The 4-day work week we hear a lot about, it's been introduced, and many companies are testing this process today and have been very successful. The real key here is this: if the result results in reducing operating costs and cycle time, that's good news, but not at the sacrifice of quality and productivity. So those are the two factors that are going to have to come and be reviewed. As I mentioned earlier, there's a huge emphasis now taking place on upscaling and reskilling. So continuous learning is really essential to stay relevant in the job market. Individuals need to be proactive about upscaling and reskilling to meet the demands of potential employers in all the different industries. So this is something that those are looking now are going to find that there's a lot of these things are happening. More than just a degree, but skills in general. If you look at the areas that are much more stable, there's always stability in essential services sector. So jobs in healthcare, pharmaceuticals, and essential services, for example, like grocery stores, delivery services, tend to be more stable, especially in economic downturns. So those that have ideas and dreams, which is great for the country, the startup challenges that can also foster entrepreneurship. People might start turning towards starting their own businesses, their own practice, enabling e-commerce platforms to do a lot of work for them. So in the old days, Bill, about going out and getting an office and all these other tools, you don't need that. You can work right at home with your own company, your own, whatever you want to do. So in summary, here's the key. Rapid change is upon us and it's here to stay. Moving forward, both employers and employees will be required to face new challenges ahead in managing the workforce. So new technologies, techniques, and processes will change the dynamic environment ahead of us. So as many industries downsize or disappear, we'll see the advent of new industries and job opportunities ahead for those that accept change with the introduction of artificial intelligence and its impact. So the challenge for organizations will be to invest in management and employee development and essentially retain or reskill their workforce to face the consequences really from their competition in the marketplace. You must remember that essentially every several years we have major disruptive forces that redefine the playing field that we live in today in the business world. But it's not limited to anything in general. However, think about this. You've seen changes where we have smartphones, we have iPads, the cloud, cybersecurity, privacy, electric vehicles, robots, texting, and so on. Employers and employees must change and adopt new methods, techniques, processes, and technologies, or they'll face the loss of market share to their competition. So these are all the elements that are taking place in the changing economy we have in the marketplace around employment. Now what I'd like to do is I'd like to spend a couple of minutes on this interesting area. So, my background is finance and accounting. We have a bunch of those folks. Major change with intelligence, artificial intelligence. So, generative AI, for example, it's a type of artificial intelligence system that really provides like text, images, or other media in response to prompts. And this technology uses machine learning to analyze the patterns and structures of data that's inputted. And then it creates new data and similar characteristics. You go back a few years, all you hear about is the term big data. There's so much data out there, it's really hard to manage and harvest. The importance is that generative AI derives its output from existing data. Now, what's interesting here is in finance and accounting, AI, they have significant impact by digitizing and optimizing critical processes involving, for example, accounts payable, receivable, spend management, liquidity management, inventory control, and all the other elements in the area of accounting and finance, as Jim Carr knows. But when you look at it, AI is really redoing finance and accounting processes. So you're looking at improved insights and decision making, increased efficiency and cost savings. That's a major driver. Here we're talking about significant efficiencies and cost savings in financial operations by automating repetitive processes, streamlining processes, and reducing manual errors. You know that the big drivers are quarterly returns for most corporations, whether they're public or privately held, and then, of course, their annual statements. And they're talking about targeting communications. In financial report generation, the biggest elements are looking at like the balance sheets, income statements, and cash flow statements. All those are major drivers of what we see in the marketplace. Another area that we found out, and you're well aware of this, is called fraud detection. By analyzing large volumes of financial data, regenerative AI systems can help identify fraudulent activity or suspicious irregularities that may take place and require further investigation. It's going to simplify and it's going to save a lot of time. Automating of repetitive tasks, as I mentioned earlier, you're going to see repetitive tasks. You can streamline them for accuracy, and you can free an accountant's time to do analysis as opposed to going back in and redoing the same task again and again. We're talking about improved compliance, which is really critical. And of course, we have improved customer service. Customers would like real-time updates on what's going on. Instead of waiting a week or two for information from your local accounting firm, you'll be able to get things in a more expeditious manner. And of course, you have what we call financial planning and analysis and forecasting. It's going to really revolutionize that whole area. When you look at specific applications, you're looking at working capital management, cash flow forecasting, accounts payable, receivables, etc. Vendor management is also critical, dealing with your clients and your vendors as well. So generative AI, it could eliminate many of the tasks done by accountants and auditors, resulting in automated generations of process reports and documents. But this does not mean you're going to see a slash in the workforce. Keep in mind, it's very hard for accounting firms, small or large, to attract people to work in that environment. Like law firms, you're going to work long hours, 50, 60, 70 hours a week during normal seasons, year-end, taxes, etc. And it's very hard to attract people in that area. This will help to some degree to eliminate some of that demand for future workers. So the under demand is here, and that'll be met by the new technologies. Furthermore, this could move us in a new direction in the whole thing on financial reporting. So that kind of gives you an idea what's going on with accounting and finance with that, because there's a lot of money spent in that particular area. So now we're going to get into the main part of the program. So what I want to talk about now is I want to look at the gross domestic product, inflation, unemployment at the federal level, the California level, and then what's taking place with the price of barrel of oil. So this is the latest information we have. So the global GDP going out the end of this year right now looks more like 2.8%. That's dropping down to 2.4%. And again, that's because of the concerns about the economies around the world, about slowing down and or going into a recession. If you look at the United States, we're looking at going out of 2.2 this year, then dropping down to 0.8 of a point. And again, that tells you the same thing, concerns about the economy next year. When we look at inflation, the target for the end of the year is around 3.6. I'll tell you more about some good news later in the report. And then we're talking about taking the driver all the way down, if they can, to achieve 2.4 by the end of the year. That's been the target for the Federal Reserve for decades, to get that inflation number down where it's more manageable. When we look at unemployment on the overall grand scheme of things, it's looking at 3.6% going out the end of this year, and then increasing to 4.2 next year, predicated on a slowing economy. The California economy, which is usually trails, we're looking at 4.5% going out this year, and then going up to 4.7 next year. Again, the same trend. The good news is in the oil window here, it dropped down again. Last month when we did the program back in September, it was around $91 to $92 a barrel. I'll give you some good news later, but we're dropping the range down now to between $80 and $100 a barrel. Let's take a look at some things in the global economy. I have a cartoonist here who's running the program. That's not me. But if you look at down under, what's happening here basically is that the central banks of Australia and New Zealand have really put a clamp now, and they're putting a hold for the time being on raising their interest rates respectively. And the UK remains at a standstill. And in this situation, we're talking about their global GDP rose about 0.2 of a point from September through August, but it's being offset by, again, a great deal of inflation. So they're struggling with that all along. So that's happening in that area. Now, if we look at the next area here, we're looking at China's economy, and they outperformed expectations to get to about 2.8% this year. And again, that's predicated on the data that they release. So if you go back several years before we started doing the program, they were up around 8 to 10% a year. So they're coming back. It's starting to turn around for them. The Bank of Canada has announced that they're going to keep their rate the same. More concerns about what's happening with inflation in their country. So their policy, their bank right now is around 5.5%, which is very close to ours. And then finally, if you look at the Eurozone, what's happening here is their economy has been very disappointing. The global GDP for the third quarter shrank by 0.1 of a point. And basically, that's the first decline they've seen in several quarters. Now, let's take a look at the domestic economy. GDP rose by 4.9% in the third quarter. That is historical. That is substantially higher than most expectations. But I want you to keep in mind that part of that's tempered by the substantial increase we saw over a 3-month period of time with gasoline prices. So that was a real driver which affected everything across the board. The second quarter was very good as well. It was at 2.1%. So we've had 6 good months this year of growth. So we'll see what happens when we close out October, November, and December. Hopefully we'll have a strong fourth quarter. And then Powell, as you know, decided that they're going to continue to target the 2% rate going forward. And so right now they've decided to hold the rate in the month of November. They met on the 1st and 2nd of November. They decided to hold the rates, which is between 5 and 5.25%. So we'll see what happens going forward. But they will not be remiss in raising interest rates if we have more bad news on inflation going forward. If that starts to rocket up again, we're going to see rates go up again as well. The housing market, the bad news here is it's headed back to the 1980s recession timeframe, according to most economists, and that's predicated on high interest rates that we're seeing now, along with lower inventory levels in the marketplace. And in the back, if you go back in the early 80s, interest rates were through the ceiling. So interest rates right now are still hovering around 8%. They just went down a little bit, and I'll talk about that later in the report. So inflation had some good news, and that is it dropped down from month to month to 3.2% from a year ago. So we saw a decline taking place, and hopefully it'll continue in this direction going forward, which if that happens and other moving parts take place, we could see the economy maybe not necessarily, it's slowing down, but not going into a recession. Again, it's too early to tell. There's too many moving parts. The wholesale index in September, the bad news here is it was up 0.5 of a point. That's what the manufacturers and everybody charge the end user. So if you're buying something, they're going to raise that and they're going to pass that on to you and I. In October, the trade exports had a solid month. It was up to $262 billion, much higher than the month of August. So that's very good news. The trade deficit. What's interesting here is several months ago, we were running between 89 and 90 plus. It dropped down to 61 billion this month, which is very good news. So we're moving in the right direction by trying to drive it down. You remember a couple of years ago, I think we were probably equal to or just above $1 trillion in a deficit. So we're gradually moving that down. Now this morning, I just saw some information on retail sales, and the sales came out. It fell 0.1 of a point, and that's the lowest it's been in 7 months. And the biggest issue they had is automobile sales were down significantly. Automobile sales represent almost 20% of retail sales. So they were down, and I think a lot of that has to do with, the interest rates that are being charged and whether or not somebody wants to participate in buying a car with those rates. Now, I'd like to take a look at the employment picture. So if you recall, when we did this in September, we were well over 300,000 jobs that were created. And now we're seeing slowing down here, period. So we saw 150,000 jobs created in October, and the unemployment rate went up to 3.9%. Now, categorically, I think, if you look at government jobs, they don't generate revenue. So there's 51,000 jobs there out of that. So if you say there's 100,000 jobs were created, you saw the area of health and education. The bad news is the IT sector, where you see the negative 9,000, continues to get hammered. And we saw manufacturing took a major hit last month, and that was 35,000 jobs were eliminated. That's not a good sign. And then we saw transportation and warehousing were down by 12,000. Now, the California report comes out from Beacon Economics. Usually it comes out around the 20th or the 21st of the month. So we're going to take a look at September data. So the month before that, we had almost 90,000 jobs were created in August. And we've slowed down here, so we have a modest 8,700, and the employment rate, that's right, 4.7% in California. That's September. We don't have October data, which won't be released probably till the day after Thanksgiving. But I want you to take a look at the categories. I want you to look at administration, finance, information, which is IT, manufacturing, and professional and technical services area. Those areas all had declines, which had layoffs throughout the state of California. So that's a negative trend at this point. We'll have to see what October looks like going forward. I talked a little bit about the area of interest rates. The thing that's interesting here is the fact that it's on hold at this point. They're going to keep it between 5.25 and 5.50. So that's the real key. So you have that, and then of course the mortgage rate, which is interesting, it was hovering at 8.03, and so now it dropped down a few days ago to 7.61. And again, this thing goes up and down, but it's still too high in terms of what we're used to. And the manufacturing index basically had some disappointing news. It decreased to 46.7 index. It was at 49 in September. Keep in mind, the basis here is 50, and anything below 50 indicates one of two things. A, we're either going into a recession or in a recession. So it's a red flag. We need to keep our eye on that. Hopefully it'll go up to 50 again sooner than later. Now, taking a look at factory orders, good news is 6 of the last 7 months, we've had an increase. It went out at $601 billion this month. Very good. And then small business confidence level, again, continues to decline. It dropped down in October to 102. But the good news is we're still over 100. If it falls below 100, that's when you start getting more concerned. And the same thing in consumer confidence in October. We saw that drop too to a level of about just under 103. So we're still over that number. Here's the good news. The oil from the latter part of like last Friday when we cut this off it's just under $77 a barrel, okay? And that dropped down from $84 a barrel the month before. So we're seeing a downturn of about $7. Even though our competition outside the country in the Mideast reduced consumption and reduced really production by 1 billion barrels a day, we're still seeing things picking up. So the demand for oil right now has dropped down across the country and across the world. So we'll see what happens in January going forward. But the good news is the trend is down in oil, and you should see that at the pumps. My friend Sid, who lives in Texas, I think, paid something like $2.25 for regular, and we paid almost $4.69 for regular at Costco in San Diego. So I mean, it's almost double the price. So we'd like to see that go down. In the housing market, the data has not come out yet. So let me give you some information. So first of all, in the month of September, we saw housing starts had great news. It was up 7.8%. Very good barometer of going forward. So starts are picking up. In the area of new home sales, we saw new home sales advance 12.3% in September. And that's the largest jump we've seen in over a year. So that's very good in that particular area. Now let's take a look at Southern California. So in LA County, the medium home that was listed was around 915,000. That increased by 3.7%. But sales were down 4.5% from August and down 18% from September of 2022, 18% lower. Orange County, the midpoint was really flat again at 1,000,003, remained the same as it was in September, but sales were down 17.3% from August and down 19.6% from September of 2022. You can see the delta there. And I think a lot of that has to do with inventory levels and number two, the interest rates, and also the impact it has on first-time buyers. In San Diego, the midpoint of the price was 973, and selling price decreased by 2.7%. Sales were down 19% plus in the month, but they were down 25% from September of 2022. So you can see what the trends are right now based upon inventory levels and also based on interest rates. If you look at construction spending, spending is still on the rise. Even though we've had some material shortages, it was up by 0.4 of a point. So that's very good for construction across the country. That's another area that's a strong barometer. Here's some great news. Productivity, which is critical in terms of labor productivity, it increased 4.7% in the third quarter. That's great. You can see in the past it's been flat or negative, but it's moving in the right direction. So we're getting more bang for the buck, so to speak. When we talk about company displacements, I try to keep it a level above a certain number because there's companies laying off every day and there's companies hiring every day. So first of all, of significance, we had Qualcomm, which is a major San Diego company, had another 1,258 job losses. We had LinkedIn is going through a restructuring, if you can believe this, 660 jobs eliminated. Nokia, 14,000. Geico, another 2,000. We had Liberty Mutual, 850. And of course, Viasat in San Diego had 800. And then we had Charles Schwab, another 2,000. And then Price Waterhouse, 600. And then Pfizer, about 800. So you can see what's going on there in the marketplace as we move further into the year. So now let's take a look at mergers and acquisitions. Keep in mind, you see there's a lot of activity. There's a lot of consolidations taking place. Even though the rates are running a little bit higher, it's still cheap money for making the deals in terms of what companies are looking to do right now. So it's very strong. So UPS is buying MX Global Logistics to expand their footprint in the healthcare industry. And Exxon is buying a company called Pioneer Natural Resources for $60 billion. What they want to do is tie up and create more shale giant work, if you will. They're picking up about 1.4 million acres of areas for their technology. Then you have the European Commission has ordered Illumina, which is a San Diego-based company, to divest of a company called Grail. What happened is they formally ordered the company to divest itself more than 2 years ago. The regulators, basically, the deal was somewhere around the $7 billion area. They were fined for approximately $456 million. And that was because they went ahead and did the deal without the approval of the European Common Market. So that's what they're going through right now. And then there's been some other changes going on within the company as well over the last several months. Now, Microsoft has been fighting with the European Common Market. The deal just closed finally of buying Activision for $69 billion. That's been a big deal for the gaming market for quite a while. So that deal is now consummated. Thermo Fisher, who's also located here, is acquiring a company called Olink for $3.1 billion, and they're expanding their footprint into some of the different proteomic product areas. And of course, UPS bought a company called reverse logistics company called Happy Returns. This is a company that was founded in 2015, and they're based in Los Angeles. What they do, they specialize in no box, no label returns. Interesting concept. Now, Unilever is selling Dollar Shave Club. For those that shave and hear the advertisements all the time, they just decided they sold it to a private equity firm. Now, Disney has finally finalized the deal to buy out Comcast Hulu stake for $8.6 billion. So that deal is now finalized. There's a company called Cedar Fair Entertainment. They own Knott's Berry Farm, and they're merging with Six Flags Magic Mountain. So you're seeing some of these areas in the entertainment space are consolidating. And I think you're going to see more of that next year as well. There's a food delivery startup called Wonder Group, not Wonder Bread, but Wonder Group. And Nestle's has invested $100 million into the company. And what they do, they're looking at selling high-tech kitchen equipment and to prepare ingredients for hotels, hospitals, and sports arenas. That's a major deal. Now let's take a look at significant economic news. The first one, which is an eye-opener, is CVS is closing 900 stores by the end of the end of next year, as pharmacy chains are battling rampant retail theft. The theft is in the billions across the board, not only for this company, but including everybody. Walmart, Rite Aid, all these companies are going through substantial theft across the board. And what they're doing in some of the areas, they're basically closing down operations. Lawmakers are really concerned right now, and they're aiming target at interest rates and fees that credit card companies are charging. And if you can imagine, it's the total credit card bill now exceeded $1 trillion in the second quarter. That's the highest ever, over $1 trillion in credit card debt. People are living on their credit cards. Rite Aid, as you know, has been struggling for quite a while. They filed bankruptcy protection, and included in that, they're putting together plans to sell off a lot of their areas, a lot of their locations. Now, there's a company called, it's First Humanoid Robot Factory in the United States, claims they will be able to build 10,000 robots a year. This manufacturing company is getting started, and they'll be in Salem, Oregon. And the idea is to come up with what they call the brainchild of agility robotics. Amazon, which kind of surprised the world, if you will, is in the process of buying 750,000 robots. And you're right, it says to eliminate workers. So they're moving in that direction. So you're going to see more changes in that area. Now, Boeing is confirming that there was a cyber attack on global services, which disrupted things from outside the country. A lot of speculation about who's involved, but I'm not going to mention that because it's not valid yet. And the last thing I want to mention again is credit card. It was a $1.08 trillion. It's a record. And the banking industry is concerned about what's going to happen if a lot of companies or people begin to file bankruptcy. The credit card companies are going to have to eat a lot of that going forward. So that kind of takes you through the ride right now and what we've seen taking place in the economy to date. So what I'd like to do is open up for questions.